You hit your number, you quit. 6 months later, you are sitting at a kitchen table with a spreadsheet that worked perfectly on paper and 3 problems that paper never showed you. If you are a high earner trying to compress a 30-year retirement plan into 10, I keep seeing the same pattern. The math is the easy part. The thing that breaks the plan is not the savings rate. It is 5 specific issues the spreadsheet does not model, and the one most people meet first is the one almost no video covers. Here's the gap. The U.S. personal saving rate at the end of 2024 was 3.8%. The savings rate the standard FIRE math asks for is 70%. That is not a motivation gap. That is an information gap. And the information most 10-year FIRE videos give you stops exactly where the real problems begin. So let me show you the 5 things that actually sink these plans, not the headline number, the things underneath it. Start with the one that hits first, access. Picture this. You are 40 years old, you hit your number, you quit on a Friday. Monday morning, you go to move money out of your traditional 401k to pay your mortgage, and the brokerage tells you politely that any withdrawal before age 59 and a half triggers a 10% penalty on top of ordinary income tax. So you do the math and you realize you have a 19-and-a-half-year wait between the day you retired and the day your largest pile of money opens up freely. 19-and-a-half years. That is longer than most marriages last. You might be thinking, fine, I will just live off my taxable brokerage until then. For some people that works. For most 10-year compressed plans, the taxable bucket is not big enough, because the whole point of the plan was to shelter as much as possible from taxes during accumulation, which means a lot of your wealth is locked behind a wall. There are 2 legal doors through that wall. The first is a Roth conversion ladder. You convert traditional retirement money into a Roth IRA in annual chunks. After each chunk seasons for 5 years, you can withdraw the converted principal penalty-free, even before 59 and a half. The catch is in that word, seasons. You have to start converting 5 years before you need the money. So if you plan to retire at 40, you start the ladder no later than 35. Most plans I see start it the day they retire, and then they are surprised when they cannot eat the money for half a decade. The second door is Rule 72T. The IRS lets you take a series of substantially equal periodic payments from a retirement account before 59 and a half without the 10% penalty. There is one situation where this basics the conversion ladder, when you did not start the ladder 5 years early and you need the money now. But here is the trap. Once you start a 72T series, you have to continue it for at least 5 years or until age 59 and a half, whichever is longer. Inflexible. If your spending changes, the IRS does not care. So 72T is the emergency exit, not the front door. Walk away from this beat with one number in your head, 19 and a half years. That is the access gap. That is plan killer number 1. And the next one is the reason a lot of early retirees end up unretiring within 24 months. Healthcare. If you retire at 55, Medicare does not start until 65. That is a 10-year gap where you are responsible for your own coverage. If you retire at 40, that gap is 25 years. COBRA exists, but it caps at 18 months and you pay the full unsubsidized premium plus up to a 2% administrative fee. Useful as a bridge between jobs, not useful as a retirement plan. The standard play after COBRA runs out is the ACA marketplace. And here is the leverage almost no one explains. ACA premium tax credits are based on modified adjusted gross income, not on your assets. So an early retiree with $2 million invested but carefully managed income can qualify for substantial subsidies. Picture this. You are 53, $2.1 million in a brokerage and retirement accounts. You sell long-held shares with a low basis, draw $55,000 to live on, and your MAGI lands well below the subsidy cliff. The marketplace treats you like a working family on that income. Your premium drops. That is not a loophole. That is how the law is written. So is the script just manage your MAGI and you are fine? No. Here is plan killer number 3, sitting right on top of plan killer number 2. As of the 2026 plan year, the 400% of the federal poverty level income cap on ACA subsidy eligibility is back in effect. The temporary provisions expired at the end of 2025, which means the subsidy cliff is real again. $1 of MAGI over the cap and your entire subsidy can disappear. On a family plan that can be $20,000 of premiums you suddenly owe. The honest answer here is that the ACA legislative landscape is contested. Different proposals would push the rules in different directions. Some would extend the enhanced subsidies, some would let them expire further. So this is the plan killer where the rule you build around today might shift before you actually retire. Build your plan with margin. Check the federal poverty level thresholds the year you retire. Do not assume the rules from the year you ran the spreadsheet still apply. Now, if you are 45 and reading this and the healthcare math is making you reconsider, hold on, because the next plan killer might change the size of the pile you actually need. Plan killer number 4, the withdrawal rate. Most videos still tell you to save 25 times your annual expenses. That number comes from the 1998 Trinity study, which modeled a 30-year retirement. If you retire at 40, your retirement is not 30 years, it is 40 or 50, and the math is different. Morningstar's 2025 State of Retirement Income Report puts the safe starting withdrawal rate at 3.7% for a 30-year diversified portfolio. For longer horizons, analysts often recommend something closer to 3%. That changes your multiplier. At 3.7%, your target is roughly 27 times annual expenses. At 3%, it is over 33 times. That is not a rounding error. On a $100,000 lifestyle, the difference between 25 times and 33 times is $800,000 of additional savings. 8 years of work for someone earning $200,000 and saving half of it. You might be thinking, that is just being conservative. Surely the 4% rule still works in most cases. The data is genuinely mixed. Some analyses argue that for a 30-year horizon, 4% is still defensible. The argument is harder to make for a 50-year horizon. And here is one place where common assumptions go sideways. Some videos illustrate this with examples that imply 7% for 30 years turns $50,000 into $900,000. The actual math is closer to $380,000. To get to $900,000 from $50,000 in 30 years, you need around 10% annualized. That is a meaningful gap, and it is the kind of soft math that makes a plan look bulletproof on a slide and fragile in real life. One more thing on this beat. People sometimes argue sequence of returns risk is the single biggest threat to a compressed plan. It is a real threat, but it is not the only one. Inflation can quietly eat your purchasing power. Longevity risk, the chance you live longer than you planned, hits hardest when your withdrawal rate is already aggressive. The mitigation tools overlap. A cash buffer of 12 to 24 months of expenses, flexible spending in down years, and a slightly lower starting withdrawal rate address all three threats at once. Which brings us to plan killer number 5, the one nobody wants to name. Behavioral drift. Here's the part that should bother you. The math on a 10-year plan does not change. You change. Behavioral economics has documented over and over that we overweight short-term rewards and underweight long-term ones. Hyperbolic discounting is a real, replicable phenomenon. It is also not the only reason plans fail. Job loss happens, family illness happens, divorce happens, kids happen. A 10-year plan asks you to hold a specific behavior steady for a decade through all of that. Picture this. Year 4, you are exhausted. You just got passed over for the promotion you needed to hit your Year 5 savings target. Your old college roommate just bought a vacation home. You sit down to update the spreadsheet, and for the first time you wonder if you should just save 20% like a normal person and retire at 62. That moment is where most 10-year plans actually die, not at the spreadsheet, at the kitchen table. There are 3 structural moves that work here. Automate every transfer the day it can be automated, so the decision is never made in a moment of low willpower. Run a quarterly review where you actually look at the compounding curve, because seeing the early years slope is motivating in a way that no projection is. And define your why in concrete terms, not freedom. Tuesday morning with no alarm, a specific project you care about, and the person you want to spend it with. Now you might be thinking, what if I just cannot save 70%? Fair. Not everyone can, and not everyone should try. At 50% savings, you reach financial independence in roughly 17 years. At 40%, it is around 22. At 25%, it is over 30. Coast-Fire is the alternative architecture. Save aggressively for 5 to 7 years to reach a number that, left alone, will compound to your full FI target. By traditional retirement age, then dial back. Many people land in their early 50s this way on a target like the Lean Fire benchmark of around $40,000 a year. Be honest about the trade-off. Coast-Fire depends on market returns over a long stretch. A bad sequence in your 40s can push the timeline back. A long bear market with no fresh contributions hurts more than the same bear market with new money flowing in. The strategy is not bulletproof. It is just better than no strategy. So those are the 5. The access gap of 19.5 years between 40 and 59.5, the healthcare hole between retirement and Medicare at 65, the lower safe withdrawal rate that pushes your real target above 25 times, the 400% of FPL ACA subsidy cliff returning in 2026. and behavioral drift over a decade that no spreadsheet models. Each one of these sinks a 10-year plan regardless of how high your savings rate is. Here's your one action before you close this video. Pull up your last bank statement and your last brokerage statement. Calculate your actual savings rate from last month, not what you assume, what the numbers say. That is your starting point, and almost everyone discovers their actual rate is lower than their imagined rate. That single number tells you which of the 5 plan killers you are closest to right now. Everyone's situation is different. This is general education, not personalized advice. Before you act on any of this, talk to a financial advisor and a CPA who know your full picture. Because the difference between a Roth conversion ladder that works and one that triggers an unexpected tax bill is exactly the kind of detail a video like this cannot see. The Roth conversion ladder math deserves its own video. The 5-year clock, how to size each conversion to stay below the subsidy cliff, the exact sequence. That one is next. And before you click it, there is a question I want to put in front of you. Most people building a 10-year plan are aiming at a number they read in a headline. $1 million, $2 million, maybe more. But the headlines almost never match what real American households actually have saved when they hit retirement. The next video on the screen takes that question apart with the actual federal data on what retirees have, and how to measure your real readiness against the income you will need rather than a round number someone wrote on a slide. If you are a high earner running a compressed plan, that is the one you want to watch next.